Ocado shares jumped 12% on a single day last week. The trigger was a software licensing deal with Asda. Peel Hunt analyst James Lockyer put a number on it. He estimated the deal adds roughly £30 million to Ocado's annual revenue. Against last year's adjusted EBITDA of £178 million on revenue of £1.36 billion, that is real but not transformational. So what is the other 10 percentage points of that share move pricing? That is the question worth sitting with here. The surface explanation is a revenue upgrade. The deeper explanation is a narrative upgrade, and those are two very different things with very different shelf lives. Ocado is not a simple grocery delivery company. It is a technology licensing platform that sells e-commerce software and automation systems to supermarkets. Asda has agreed to use Ocado software across store picking, fulfillment, and home delivery. The rollout is scheduled from early 2027 onward. The 12% move prices the possibility that this is the beginning of a domestic client rebuilding cycle. Before this deal, Ocado's technology arm had been under sustained pressure. U.S. supermarket giant Kroger closed 3 Ocado-powered warehouses in 2025. That event installed a specific bear thesis in the market. The thesis was this: Ocado's capital-intensive model does not survive contact with large-format retail at scale. The Asda deal lands directly on top of that read. A major UK grocer is selecting the same platform at the exact moment the bear case was most entrenched. That is the anomaly worth investigating. But here is what most coverage of the story is skipping over. The Asda deal is, at this stage, software only. When Ocado CEO Tim Steiner spoke to the Financial Times, he was careful. He said, "We hope in the future they can start to think about adding some automation." That word, hope, is doing a great deal of work. The deal as it stands licenses e-commerce software. The automation layer, which is the high-margin centerpiece of Ocado's technology value proposition, is aspirational. It is not contracted. The market priced the full platform re-rating. The contract delivers the software layer only. The gap between those two things is where the real positioning question lives for holders of Ocado right now.
To understand why this deal moved the stock so sharply, the Kroger episode needs more than a passing mention. In 2025, Kroger announced it would close 3 warehouses built using Ocado's robotic fulfillment technology. The closures raised a fundamental question about Ocado's model. The warehouses had been expensive to build and required sustained volume throughput to be economically viable. When Kroger shut them down, it signaled the economics had not stacked up in practice. Kroger later agreed to pay Ocado $350 million in compensation. That number confirmed the closures were a contractual failure, not simply a business decision. And it locked in the market's dominant interpretation for the months that followed. The interpretation went like this: Ocado's automation-led model is brilliant in theory, but operationally fragile. U.S. retailers overestimated volume growth. The capital requirements are too heavy for partners to absorb if volume targets slip. That reading compressed the valuation. Here is the hidden assumption the bear camp carries from that episode. They presuppose that Ocado's revenue durability depends on retailers making full capital expenditure commitments to the automation layer. Software licensing alone, in their model, is insufficient to support the valuation. If Asda never upgrades from software to automation, the bear thesis is not invalidated, it is actually confirmed. The bull camp holds a different hidden assumption. They presuppose that a domestic client win restores platform credibility that foreign clients cannot easily provide. Asda is not a Kroger-style bet on U.S. grocery volume growth. Asda is a structurally familiar market where Ocado can point to Morrisons as an existing software client running online operations today. 2 major UK Kaisers on the platform is the beginning of a portfolio argument. The bull assumption is that software client depth creates the conditions for automation upsell over a 3 to 5 year horizon. Both assumptions are logically coherent. Neither is definitively falsifiable by the Asda deal as currently structured. That is why the 12% repricing feels unstable. It is not an agreement about what the company is worth. It is 2 different groups pricing 2 different futures on the same news headline. The Asda Q1 results, released alongside the Ocado announcement, add further context. Asda has spent more than £1 billion moving away from systems operated by former owner Walmart. That project caused disruption to stock availability and weighed on sales. The Ocado relationship is remedial as much as it is strategic. That matters for how Ocado holders frame the upside path. Asda has 700,000 online grocery orders per week, according to Steiner. That is a real volume base for the software layer to serve. Whether Asda's recovery trajectory is strong enough to make that base grow, and whether growth creates conditions for automation investment, is the dependency chain that neither the deal announcement nor the Q1 results resolve.
There is a forward checkpoint embedded in this situation that deserves explicit attention.
Ocado said the e-commerce technology rollout at Asda begins from early 2027. That implementation timeline is the first observable gate. Slippage or complication in that rollout would immediately reactivate the Kroger-era read. Smooth execution would reinforce the bull platform thesis. But the more material checkpoint is not the rollout date itself, it is the automation conversation. Steiner flagged it explicitly. Beyond software, the partnership could eventually expand to include Ocado's automated warehouse technology. Eventually and could are not forward guidance. They are conditional language signaling that automation adoption requires Asda to first demonstrate sufficient e-commerce volume and financial headroom. This creates a precise dependency. Ocado's full valuation re-rating requires Asda's recovery. Asda's recovery requires its online offer to improve. Ocado's software is the tool meant to enable that improvement. The circle is logically coherent, but the timeline is long and sequential, not parallel. Morrisons provides the nearest available comparison. Morrisons already uses Ocado software for online grocery operations. The articles do not confirm whether Morrisons has added automation on top of that software relationship. If it has not, that is relevant context. The software to automation conversion rate from existing UK clients may itself be zero so far. The question a holder of Ocado is left with is precise. The 12% move priced a platform narrative upgrade. The Asda contract delivers a software licensing revenue line worth roughly £30 million per year in analyst estimates. Locker also estimated approximately £20 million in additional EBITDA contribution based on Asda generating £3 billion in e-commerce sales per year. If Asda's online volume growth disappoints, if the turnaround Steiner is banking on does not materialize, the rationale for automation investment disappears before it was ever formally proposed. In that scenario, the 12% repricing looks less like the start of a re-rating and more like a relief rally on a name that had been overly discounted since the Kroger episode. A relief rally and a re-rating are not the same holding thesis. They imply different time horizons and different exit conditions. The concrete signal to watch is Asda's online grocery order volume trend once the Ocado platform rolls out from early 2027. The second signal is whether either Asda or Morrisons publicly announces a progression from software to automation. Until one of those signals arrives, the gap between the 12% move and the £30 million revenue addition is the residual interpretive risk embedded in the current price. That gap, not the headline number, is the variable that separates the two camps. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.